Welcome to Yahoo Finance Live. I'm Shauna Smith alongside Dave Briggs. Let's get you up to speed on this afternoon's market action. Stocks are trading higher as we enter the final hour of trading. Treasury Secretary Janet Yellen saying that the government could step in to help contain the contagion if there were further runs on the banks.
Then it's all about AI. Google officially launching its ChatGPT rival Bard today, while NVIDIA is unveiling its latest AI-focused products at an event as well. We'll have more details coming up. But first, let's get you up to speed on what's happening with the banks. First Republic doing a complete 180 today from Monday, now leading a rally of the regional banks. You see it's now up over 30% in the last hour of trading. This comes after reports of another JPMorgan-led rescue plan for the bank and a speech from Treasury Secretary Janet Yellen this morning at the American Bankers Association. She talked about the state of our banking system and plans to monitor institutions going forward. Listen.
The public should have confidence in our banking system, and it's our intention to remain vigilant in the days and weeks to come. Our intervention was necessary to protect the broader U.S. banking system, and similar actions could be warranted if smaller institutions suffered deposit runs that pose the risk of contagion.
Joining us now is Alexander Yoakum, CFRA Research Equity Analyst. Good to see you. So are those statements in contrast to one another? Faith in the system, which is secure, but yet we're poised for further action if needed.
Yeah, I mean, I would say just in general, the comments were quite positive. I think that's why you're seeing regional banks outperforming today. I mean, there is some concern about the health of the banking system, but I think the large concerns about a bank run are largely behind us. Two Sundays ago, we had the comments that uninsured deposits would be made whole at Signature Bank and Silicon Valley Bank, and I think those comments took a few days to kind of go through, but at this point, I think people have calmed down a little bit.
So, Alexander, you don't necessarily think that we will see more runs on the bank because some of the regionals, yes, we are seeing, I guess, some reassurance today, but they have certainly been on a wild ride here over the last 2 weeks.
Yeah, so I'm a little bit less concerned about a full-fledged bank run. I think the fact that the banking industry has kind of helped out First Republic so much. But that being said, I would expect some deposits to move from regional banks to large banks. I am also concerned about profitability. Potentially we'll have higher regulatory costs for smaller banks, and then potentially deposit costs will go up. From 2019 to 2021, we had excess deposits. Banking deposits went up 40%. But given the recent news, I expect deposits to now be much more valuable, and therefore banks will probably have to pay more on those deposits, and that will impact profitability. And I would expect that to be more for the regional banks than the larger banks.
Secretary Yellen also mentioned a need to rethink banking regulations. Let's listen to what she said there.
We will need to re-examine our current regulatory and supervisory regimes and consider whether they are appropriate for the risk that banks face today.
What's your expectation on the regulatory environment? Is there anything they can do without congressional approval, which seems at best unlikely at this juncture?
Yeah, so I definitely think there's a chance that enhanced supervision comes down. So before this, it was at $250 billion in assets, and Silicon Valley Bank was just under that at about $200 billion in assets. So I wouldn't be surprised to see that come down maybe to $100 billion in assets, just given the fact that these large banks clearly caused turmoil when they went down.
Alexander, the flight of some of the deposits there from the regionals, you mentioned some of those larger banks are attracting some of that money. Who stands to benefit from all this?
Yeah, so I think the obvious answer is, is the larger banks. But I think it's clear that they don't want small banks to go down either. Because if you think about the financial crisis, probably a lot of banks initially thought they were gaining market share, and then eventually it ended up being bad for pretty much everyone. So I think they're definitely trying to keep, First Republic specifically up. But yeah, I mean, the larger banks, they are generally being viewed as safe right now. and deposits are generally flowing there, whereas a lot of the regional banks are seeing outflows. So I think larger banks probably is the answer. The only thing to note, though, is that because they've benefited from this, there's a chance that they will be required to help out a little bit more in terms of paying for this. So they've made it clear that this would not be paid for by taxpayers. It'll be paid for by banking, any losses from these failures. So because they've benefited, there's a chance that they'll have to pick up a little bit more of the tab.
And when it comes to First Republic, you say its actual location impacted where it is today in terms of its price, its the faith that investors have. Why so?
Yeah, I don't want to be too hyperbolic here, but I truly believe if they were based in a state like Alabama, they would not be struggling like they are now. So the fact that they are only 50 miles away from Silicon Valley Bank, their headquarters, and nearly half of all their deposits are in that Silicon Valley. How I think it played out is on Friday, when Silicon Valley Bank clients were trying to take out their money and they couldn't, they're friends with a lot of First Republic clients, and they got really worried and started to take out their money. And I think that continued significantly on Saturday. And by the time the positive news came out about uninsured depositors being made whole, it was a little bit too late. I actually heard anecdotal evidence that on Monday there was long lines in front of First Republic offices in the Silicon Valley, but in other places like New York, there weren't large lines. So I really think when all your friends around you get worried, you're more likely to move your money than if potentially just one or two of your friends are getting worried.
Interesting. So how much do you think this is actually emotional?
Very emotional, because Silicon Valley clearly had problems, right? Their securities portfolio was very underwater, but banking is based on trust, and the second you lose trust, everybody gets out. So like I said, I don't think First Republic would have gone down if Silicon Valley Bank didn't go down. Or I guess they haven't gone down yet, but just in terms of stock price, they've gone down significantly, and they have had deposit outflows. But yeah, I think it's a lot of just trust based, and I think emotions play a significant part. When people get scared, they just don't want to be part of it.
And Alexander, how much of the activity over the last couple of weeks has really been social media driven? So much of the panic that we certainly did see play out on Twitter, on Instagram, and on TikTok as well.
Yeah, so because this isn't credit-based, if it was credit-based, I think banks, eventually would get in trouble. But because it's securities portfolio-based, if deposit flows were slower, I think, potentially even Silicon Valley Bank could have been okay, and probably definitely Signature Bank. So yeah, I think it goes a lot quicker. And like we were talking about, like with fear about First Republic, I think people, move their money, ask questions later. So I think statements can get over exaggerated on social media, and the run can happen a lot quicker. I mean, there were reports that 25% of Silicon Valley Bank's deposits were attempted to be taken out in a single day. I don't think that could occur without social media.
I think it still remains at this point a Bloomberg report, but that the mid-sized banks pleaded for FDIC insurance backstop for 2 years. What's the likelihood, if in fact that request was made, that it is granted?
Yeah, it's hard to say. I mean, it's changing quickly right now. I think if another regional bank goes down, that is much more likely to go through. But it would definitely be good for regional banks as a whole, and probably stem a little bit of the bleeding. But it's a very fluid situation right now, so it's a bit tough to say.
Alexander Yoakum, a CFRA research equity analyst, thanks so much for joining us. We are just getting started here on Yahoo Finance Live. Coming up, as the banking crisis drags on, the Fed's path for rate hikes remains unclear. We will discuss what could be the Fed's, quote, most up in the air decision yet. Then Duckhorn Portfolio CEO Alex Ryan is joining the show. He'll explain what the demand looks like for a luxury wine and also the company's recent earnings results. And more earnings rolling in. GameStop and Nike are set to release their quarterly earnings after the bell. We'll bring you those numbers as soon as we have them. Don't go anywhere.
Unrealized losses.
The unrealized losses.
We've been hearing the term unrealized losses a lot lately, but what does that mean? It's basically losses that are on paper. If you have an asset on your balance sheet as a company, an institution, it fluctuates in value, right? Because it's something that is pegged to the market. If that asset has gone down in price on paper, that is on your balance sheet, you have recognized a loss, an unrealized loss. That loss only becomes realized when you have to sell that asset if the price has gone down. One maybe easier way to think about it is to think about a real asset that might be on your personal balance sheet, like a house, for example. Let's say that you buy a house at $300,000 and you live in that house for a while, but then something happens in the housing market. The price of the house goes down a little bit, say to $250,000. That means it's an unrealized loss. You haven't sold the house, you still live in the house. If something happens and you're then forced to sell that house, you take a realized loss. That unrealized loss becomes realized because you've made the sale. But let's say you live in that house for a while longer and the price goes up. Well, then you don't have an unrealized loss anymore. You actually have a gain. So that's how we can think about these various issues. These losses don't become realized unless, like some recent companies in the news, you are forced to sell for whatever reason.
Do a quick check of the market. You can see stocks trading higher here with the Dow up just around 268 points, S&P up just over 1%, the Nasdaq, the outperformer, the three major averages up just about 1.5% today. The gains coming ahead of the two-day meeting that we certainly have for the March FOMC. The Fed decision is tomorrow. Lots of talk about whether or not we are going to see a rate hike. For more on this, let's bring in Keith Lerner. He's Truist Co-Chief Investment Officer. Keith, it's great to see you. So before we get to the Fed and the expectation there, I want to start with how the market has been behaving over the last couple of weeks, because despite the chaos that's been going on in the banking sector, the market has remained pretty resilient. The S&P closing up 1.5% last week. What do you attribute this to?
Yeah, well, great to be with you, Sharon and Dave. You're right. I mean, the market last week was up 1%, 1.4%. Part of this is, the first thing is, from a technical level, the 3,800 level found support. So investors stepped in at 3,800 level, so that's a positive. The other thing is, when you look at the overall market, you have to look underneath the market to see really what's happening. And last week, what you saw is big cap growth, which is a bigger part of the overall S&P, was up 5%. Think about technology, communication services, and that more than offset some of the weakness we were seeing in more of the financials, banking stocks, and also energy and materials. And then this week, we're actually seeing a bit of a rebound of those being up areas as well. So listen, all in all, I think what the Fed did as far as providing the backstop has helped provide some confidence for the market. That said, I know a lot of folks are waiting for, the Fed, as you mentioned, and I know you'll have some questions on that, but we don't think that's a panacea, even if they cut rates tomorrow. Even if they pause tomorrow.
If they do raise tomorrow, Keith, and the belief is probably a 25-point hike, how will they respond?
Well, right now, I think if you look at the Fed funds futures, that the high probability is still a 25 basis point move. I think it's going to be more important what Powell says in the press conference, and that's often been the case, and how much he acknowledges some of the financial strains. And also, is it going to be a dovish hike insofar as that he discusses that they're on hold thereafter? So historically, when we look at these, these rate cycles, you typically do get some type of rally. I think that's part of the reason why the market's rallying today. However, I will say this. Whether the sustainability of any rally is really dependent on where the economy is going. Our view is that there are still elevated recession risk into the back half of the year. So if we do get any type of rally, we would be fading that rally, especially anywhere in the 4,100 to 4,200 level. And the reason being simply is, even today, we're trading around the 10-year average valuation for the market. Our point of view is there's above average macro risk at this point. So we just don't think you're being compensated for taking on a lot of risk today.
Keith, when it comes to maybe investors looking to take on risk, lots of people are looking at the activity that we certainly have seen in the banking sector. Treasury Secretary Janet Yellen responding to whether or not the current banking crisis that we are seeing, how that relates to 2008. Obviously, she made the point that it's very different. Let's take a listen to what she had to say, then I want to get your reaction.
Well, we don't yet have all the details about the collapse of the two banks. We do know that the recent developments are very different than those of the global financial crisis. Back then, many financial institutions came under stress due to their holdings of subprime assets. We do not see that situation in the banking system today. Our financial system is also significantly stronger than it was 15 years ago.
Keith, how are you looking at the recent activity in the banking sector and potential investment opportunities there?
Yeah, well, the first thing, I do agree this is a lot different in 2008. I took over as the chief market strategist late in 2007, so I lived through every tick of the financial crisis. And as mentioned by Chair Yellen, is that was a credit crisis with a lot of bad loans. This is a liquidity crisis with actually holdings of really high quality paper. So I think it is different in that respect. But either way, I think from our perspective, before this, bank lending trends were becoming tighter already. So after what happened the last few weeks, our view is bank lending trends are only going to become more tighter going forward. And that's important insofar as that credit is the bloodline of the economy. And we think that the economy was likely already to slow because all these Fed rate hikes over the last year still haven't fully filtered into the economy. And this will only make things somewhat tighter. So even, as you've seen the market rally and the 10-year Treasury come in, credit spreads have actually widened somewhat. So, from our point of view, this is still, we're going to have some challenges ahead. And then more specific to your question on financials, after you have a shock period in a sector like we've just seen, typically what you have is a tug of war between fear and greed for a while, and you have a lot of back and forth without a lot of traction. So in our view with financials, we're neutral at this point, and we think it's going to just take some patience in that sector.
A lot of patience based on some charts that you sent over to us. You mentioned taking over in that 2007 period in which Fed rates were falling. But stocks weren't rising with those falling rates, similar to what we saw in that 2000 to 2000 period, 2000 to 2002 period. When will we see rate hikes begin to fall? And do you expect a similar performance from the markets?
Yeah, well, there's a lot of, I talk to a lot of institutions and even some of our clients, there's this discussion that, hey, the Fed pivots, the market's off to the races. And to the point you just brought up is that historically, if you do go into recession, just cutting rates doesn't necessarily end the recession or is a boost to the market. The times people remember where a pivot really helped was 2019 or 1995, where a recession did not occur later on. We think recession risks are relatively high. So, if the economy does weaken later in this year, we expect to see likely at least 1 or 2 rate cuts later this year. But the market was getting ahead of itself in our view, pricing in about 3 rate cuts. And the other thing is, if we get more than the 2 rate cuts or 3 or 4, in our view, that's likely because the economy is even weaker, and that's going to hit corporate profits. So for a lot of folks rooting for aggressive rate cuts, we don't know that's necessarily the best thing for the overall market. And that's one of the reasons we remain overall somewhat more defensive.
Indeed. All right. Good stuff there. Keith Lerner, Truist. Always good to see you, my friend. Thanks. Coming up, existing home sales rose in February, hitting its first gain in 13 months. We'll talk to National Association of Realtors Deputy Chief Economist on all things housing next.
Let's do a quick check of the markets. We've got about 35 minutes to go in the trading day. This market check sponsored by Tasty Trade. Once again, all 3 of the major averages holding on to gains. The Dow up 267 points. Nasdaq leading the way as we see a lot of the larger tech names push to the upside. The Nasdaq up just about 1.5%.
Some good news out of the housing sector today. Existing home sales rising 14.5% in February. That's according to the National Association of Realtors. That's the largest monthly percentage increase since July of 2020. Joining us now is Jessica Lotz, National Association of Realtors Deputy Chief Economist, and Vice President of Research. Nice to see you. Do you believe this is a blip or the beginning of a pattern? And where is it most pronounced? Much like Tip O'Neill said about politics, all real estate is local.
Indeed, all real estate is local. And we certainly are seeing home buyers back. They are excited about the spring market. They've gotten used to slightly lower rates than when we have seen that peak of 7%. I have to say the most pronounced is in the West region, where perhaps buyers actually had a little negotiating power and they were taking advantage of that.
Jessica, where do you think we'll see the 30-year rate trend here? Do you think we're going to stay within that 6 to 7% range? Will we potentially get back above 7%?
I hope not. I do hope that we stay in that 6% range. That is our forecast, and maybe even dipping lower than that into the 5% range towards the end of the year. I have to say that buyers have gotten used to it. They understand that 3% is not going to happen anytime soon. And so they understand that they're going to have to pay more for the mortgage. All of that said, if we compare today's market versus last year's market, we know that last spring was insane. There was a lot of buyers coming into the market, really bidding up home prices and getting pretty frantic, waiving a lot of contingencies, trying to get into the home buying market. So right now, in a little more balanced market, is certainly healthier for home buyers coming in.
And it was really just a bit of a really quick downturn for rates that presumably caused the numbers we just saw. Do you think, again, to my prior question, is this the beginning of a long-term trend or just a 1 month, one-off number?
I do think that we have seen the bottom. I think that hopefully home sales will continue to increase. Certainly there's investors who are still in the market, but primary residence buyers thinking about those first-time home buyers, potentially millennials who want to enter into the market, baby boomers who are retiring, all of that is driving demand all at once. And so I think that we are going to continue seeing home sales rise. I think we would have seen them higher if we had more inventory, and that's what we're really lacking right now.
Yeah, Jessica, what is the inventory picture right now? Have we seen any improvement? Because it looks like certainly a lot of regions still lack that inventory. So then that also begs the question, how many offers are some of these houses getting?
Yeah, absolutely. So we still have under 1 million units right now for sale. And if we think about the demand that's there, it's really not meeting that. In fact, we're seeing 2.7 offers for every home that's out there right now. Again, better than last spring when we saw 5.5, but again, 2.7 is a lot. That means there could be a potential bidding war, especially in incredibly hot areas. And we know that every neighborhood has that special area that someone wants to move into, and that could have the potential of bidding up prices.
Yeah, we're still seeing about 2.5 months of supply. We need about 4 to 6 to be truly healthy. We also saw prices decline, albeit 0.2%, but that was the first time in more than a decade that prices fell year over year. Again, regionally, where are prices falling the fastest? And do you think they'll continue to fall for the remainder of the year?
You know, I think it's hard to say with prices, especially when we know that there is the volatility in interest rates at the same time. If we look at where prices are really falling the most, we really are talking about those hot areas where we saw a lot of migration flow into. So the Boise's, unfortunately, the Austins, Salt Lake City, we saw home prices being bid up competitively in those areas throughout last year. And so now we're seeing that shrink. Now, I have to say, I don't know what's going to happen with home prices, but knowing that there's not much inventory and there is potential demand out there, it means that there could be some equilibrium that happens and continues to happen in the marketplace. And yes, 0.2%, sure, it's a decline, but we have to take that into context of 10 years of steady growth.
Jessica, on the map that we were just showing, certainly the West Coast, we saw a huge jump, the month-over-month jump that we did see. What do you think we're going to see in terms of the fallout from SVB and some of the crisis that we are seeing playing out in the banking sector? Because yes, on the one hand, leads to lower rates because of the drop in the 10-year, but also the fact some of the instability there could cause some home buyers to stay on the sideline.
It's possible, but I think any home buyer who's seriously looking is their first call is going to be to their mortgage broker and say, can I lock in a lower rate? And can I actually competitively get into the home buying market right now with that lower rate? And they're going to move forward with that. I think we all know that one regional bank is one regional bank, and it's not looking like a wider fallout at this point. So I don't think that they're going to be broadly concerned. That being said, if they're in the tech sector, if they're living in that local area, certainly they're going to be feeling that worse than in other areas.
Indeed. Jessica Lotz, thanks so much. Appreciate all that. Coming up, shares of on holdings, those running shoes y'all know and love are trading higher. The company's seeing a massive jump in net sales this quarter. We'll tell you how the Swiss sportswear brand is setting themselves up for what they're saying may be their best year yet on the other side of the break.
Time for a triple play. 3 stocks that we're watching the final 30 minutes of trading. And let's start with Roblox. We have Roblox, we have On Holding, and we also have Alphabet. I'm jumping the gun here, but let's get to it. Let's get to Roblox. D.A. Davidson reiterating a buy rating on the stock and a $55 price target, making the case that Roblox could benefit from generative AI. Now, analyst Franco Grana saying that he's making the case that Roblox could boost its revenue, Roblox's revenue, by over 5% in 2024 from implementing the AI technology. While the timing, though, is still unclear, he does see it as a growth catalyst for several years. Now, in terms of what we know for Roblox's AI ambitions, they have launched their first 2 tools in regards to AI. They're called the Code Assist and also the Material Generator. Both are in beta right now. Roblox's stock, though, has been on a wild ride this past year. Recent data, though, showing that user base is growing. Daily active user gains the highest that they have been in February over the last 5 months. So Roblox needed something, maybe, Josh, to stabilize the wild swings that we were looking at that chart right there. AI, if any company mentions it, it seems like investors latch on to that. So we'll see whether or not it works for Roblox.
And Roblox has rode the metaverse wave as well, we should mention, right, with the stock and sort of getting a boost from that. So interesting now to see them getting into AI. Of course, it fits with the metaverse play. That also fits with what Roblox does. So certainly interesting to see. And Shauna, you pointed to just sort of the natural fundamentals we're seeing from Roblox starting to pick up a little bit too. Wedbush noted that last week as well, saying bookings have met their estimates for the last 3 months now. So maybe starting to see a little bit more consistency in what's been a little bit of a volatile run there.
Yeah, it certainly has been a very volatile run, and I think a lot of people are just trying to figure out what exactly a name like Roblox, it is consumer facing, remember that. So at a time when the macroeconomic environment, the landscape there continues to slow, that of course could have an impact on Roblox too, at least in the near term.
Consumer facing, we got to talk about what might be me and Dave's newest pair of sneakers. We're gonna see. On Holdings is on
Me
a
too.
wild
Don't
ride
leave me
today.
out there.
Right? Shauna likes them as well. Dave's been
I'm the
messaging
only
me
one
them all
of this
day.
group that have bought a pair of these. So
That's
let's,
fair.
Full
let's
disclosure, I was actually sending him messages.
Dave's been sending me on shoes
Alright,
all
now
day.
I don't feel as left
Let's
out,
talk
I
about
guess.
On. It's on a wild ride today, up over 20% as the company beat on the top and bottom line. Now, revenue for On was up nearly over 100% from last year. That net revenue up at over about $360 million, guys. And the other thing I want to point to with On that was interesting to me here is when you take a look at how widespread the revenue gains were. We're talking over 80% in North America, over 80% in Asia, over 80% in Europe. When you talk about how wide that growth is, that is a huge net to cash. Also, they're projecting gross profit growth, margin growth of 2% over the next year. That's something when you talk about a growth stage company, they're investing in growth and they still think their margins are going to improve. That is going to excite investors every single time, and you see that exciting people today, Dave.
You see that on a Wedbush note. In a nutshell, this was a print with almost no holes to poke. That was not Dan Ives, that was just Wedbush. But a $32 price target actually surprised me because that's only about roughly 17% upside. I figured that might be a higher price target given there were no holes in it. Did not realize actually how much they had ventured into the apparel category. One occupied by Lululemon and others, pants, hoodies, jackets, t-shirts, you name it. But anecdotally, Josh, I commute with Wall Street, and I have noticed over the past year or two, it has become workwear. It has become office wear for Wall Streeters. It's almost like the new Patagonia vest, if you will.
Sure.
And so that tells you a lot of, it's not just the hardcore runners that they are capturing here. No offense, Wall Street. These are not runners that I'm seeing wear these shoes to work. They have really dominated this category.
It's the casual shoes that go with the Lululemon pants, right? And you get the full athleisure sort of jumpsuit. Because Lululemon, for what they've done in women's footwear, we started to do, they don't have that comp for men's footwear.
Right.
And I wear Lululemon pants every day, and I
thought
want some
that was a
comfy shoes
miss.
to go with them.
And the Roger was a really smart play for them. I always have said this. I'm surprised the Messi has not been a similar play from Adidas, who has a massive hole to fill and has the most famous athlete on the planet.
Yeah, and I also think when you take a look at these numbers, the demand here, what also stuck out to me was 90% of their sales during the holiday period. And I looked for these shoes to be on sale when I was purchasing them in the holiday period. They were sold at full price. Speaks a few things. One, to the demand out there simply for their apparel, for their shoes. And then two, just the inventory issues that we have seen plague so many of their competitors out there. Doesn't seem like it's
impressive
having any
inventory
impact on
control,
On.
right?
Yeah.
For a retail company where
Very.
a lot of retail companies have struggled in that department.
Yeah, other than Jordan's, markdowns are a constant in the footwear industry. All right, my play is Alphabet as Google shares popping today. Let's check out up almost 3.7%. Wow, on a buy rating from Stifel and a price target of $130. Now, first they talk about AI. The analyst Mark Kelly writing a note, quote, while the early demos for Bing via OpenAI have been quite impressive, we do not expect a monumental shift in consumer behavior nor search ad spend shifts. Kelly sees substantial opportunity for YouTube, which maintained its market share overall over Netflix, 7.9 to 7.3%, as well as YouTube TV, who recently raised their prices 12% from $64.99 to $72.99 per month starting in April. And that represents 108% from their original price of $34.99, mind you. You can see shares up almost 3.8% and 17% year to date. YouTube TV, I do have that product.
You do.
I like it. The interface on the phone, on the mobile app is brutal. I assume at some point they will fix it, but some interesting innovations that you have to point to as well from YouTube TV.
Well, so when you see these price hikes, the number one question you wonder is, well, what am I getting now that you're charging me more? And I was wondering that last week. I went home, I'm watching March Madness, I'm on Twitter, and what do I see? Multi-view. Look at this. 4 screens at once. You can watch 4 games at once. The way it works is you can hover over a game, When you're hovering over it, that's the one you're listening to. Then you press select and you can go full screen on that game. So sort of NFL Red Zone, maybe NCAA Fast Break for those that watch a show like that during March Madness. It's that on your own app through YouTube TV. I was pretty impressed by it. I'm not a YouTube TV subscriber, and it certainly attracts me more to the product.
Yeah, I'm very impressed by it, and it also makes a lot of sense. You're right. When companies do raise prices on certain products, they need to really hammer home why you should be paying more for that. And I think a lot of people ahead of this upcoming NFL season are trying to figure out what network, what distribution channel they should really turn to. This potentially gives YouTube a huge leg up. If you're able to, I don't know what the rights are, but if you're able to watch 4 NFL games at the same time, that's massive.
I will say it's for March Madness. March Madness Fast Break is the way to go if you want to see all the games.
Yeah, exactly. You need the
If any of you haven't seen it next year, you must. As for the NFL, and as for this innovation, it's only been used with March Madness right now, and they had to be pre-selected. Only could have had games that were on for March Madness programmers. So they haven't expanded beyond that, and they have not referenced whether or not they're allowed to do it with the NFL. The NFL contract has every contingency you might imagine. They've already thought of that before you have, I trust. So they own Red Zone, does the NFL. My assumption is there is no way they will allow this.
But if you can sell more Sunday Ticket, you could argue that maybe it's just as useful as Red Zone, right? Because then you could maybe even someday phase out Red Zone. We all play our own Scott Hansen.
Yes.
And then you sort of get rid of it in that way.
No one can play Scott Hansen.
Right. But you can try to.
Just like no one can play Steve Briggs with Fast Break. Exactly.
That is correct. There's only one Scott Hansen and
one other thing I did want to add with it, though, quickly, Dave, that does impress me with is when you think about sports gambling and the tie-in there, people like to see what's happening as it's happening so you can gamble on games. One thing right now that you have to consider with Red Zone, you're behind what's happening in real time. You're not seeing it as quickly.
Yep.
So if live betting, and we keep talking about it increasing, you want to be able to see what's happening as it's happening so you can accurately bet.
Is there anything out there that's offered like this right now?
Not to my knowledge that I've used.
I grew up with picture-in-picture where you used
Even
to.
you could.
Yeah, you're probably too young to remember that.
I didn't. No, but I get what you're saying there. All right, well, coming up next, the U.S. Supreme Court taking on its first crypto case. We've got the details for you next. The U.S. Supreme Court hearing arguments from Coinbase today over whether or not the crypto exchange can force customers into arbitration. Alexis Keenan is here with a special guest for the latest on that. Alexis.
Thanks, Shauna. Joining us now is Hassan Zavari, who argued today against Coinbase before the Supreme Court. Hassan is representing Abraham Bielski, who had more than $30,000 stolen from his Coinbase account. Welcome, Hassan.
Hi, nice to be here.
So your client, Mr. Bielski, he's among a class of plaintiffs who went after Coinbase, sued Coinbase for very different reasons. But what those plaintiffs, what they have in common is that their cases got into court despite the user agreement from Coinbase that says very specifically that all disputes between its customers and the platform have to go to arbitration and specifically not into U.S. court. So Coinbase, of course, disagrees with this and is asking for its cases to be stayed while that determination is made by an appellate court. So explain why your client and others like him need these cases to go forward without delay.
Yeah, thank you, and it's good to be here. Listen, the thing about arbitration is that it is being used by corporations, banks, and other large institutions to keep people out of court and to prevent them from teaming up together to try and help one another when there are smaller cases like this. Mr. Bielski lost $30,000, but there are hundreds, if not thousands, of other people who lost money also because of Coinbase's deficient security practices. And so what Coinbase is trying to do is to use the arbitration clause to delay things. The judge already found that the arbitration clause is not enforceable. But while that's up on appeal, what they're saying is that we shouldn't be able to go forward with the lawsuit. They want delay on top of delay. And what we're arguing about today is whether or not the case should go forward and whether we should be able to proceed now that the judge has found that the arbitration agreement is not enforceable.
Now, Coinbase and other tech companies, they have been targeted by class actions, by individual plaintiffs, saying that they want to avoid this type of litigation. But what are the risks, though, to Coinbase and other companies trying to use these arbitration agreements if you win your case? What kind of risks are they facing?
Well, I think the biggest risk is actually a benefit. And the risk is that they're held accountable and that they ultimately have to follow the law and they have to increase their security and they have to take care of customers when their money is stolen by scammers. And ultimately, that's what all financial institutions are meant to do. It's what they're supposed to do. And so they're playing games, they're trying to hide from this class action. But ultimately, if they are forced to follow the rules, if they are forced to comply with the same laws and regulations that apply to other financial institutions, it's going to be good for business. It's going to be good for them because people will have trust in Coinbase and other institutions like them that their money, their crypto is safe. But right now, there just is absolutely zero confidence in that.
Now, one of the things that Coinbase's lawyer talked to during the arguments with the justices is that it would be possible that during discovery, if these cases went forward in the trial courts, that there could actually be some embarrassing information that could come out. So is that too a risk, given that arbitration is often limited discovery and a lot of these things happen behind closed doors in terms of getting to if there is even a settlement in these cases?
Yeah, Mr. Kochel raised that argument today, but I think it's a bit of a red herring because actually most arbitrations are not confidential. The rules of the AAA and JAMS, which are the two biggest arbitral organizations, do not require confidentiality. And any information that comes out that's confidential can be protected by a protective order. It's really just an excuse for trying to come up with a reason for delay. It really is something that if there really was something that was like competitively sensitive, there are protective orders that can be put into place. So frankly, I don't see much in that argument. And it didn't seem to impress the justices either.
Now, more broadly, when we look at whether it's Coinbase or other crypto platforms, other tech companies that hold these types of digital assets, if you do end up winning your case, do you see that then as being kind of a power shift for the users who use these platforms to exchange financial assets. Does that change the playing field between the platforms and the customers?
Well, I certainly hope so, and that is our aim. Our aim is to bring some fairness to the process. Let me just give you a little bit of an example in this case. Mr. Bielski, after he lost $30,000, could not even get in touch with anybody from Coinbase. He tried emails, he tried calls, he tried chat bots, and couldn't reach a live person. That's just not tenable in a financial institution that has hundreds of millions, if not billions of dollars of people's assets under control. So yeah, we hope to make a major change in the way that Coinbase operates its business and to make it accountable to its customers, which ultimately it could not exist without those customers.
Well, I know that a lot of companies that use these type of mandatory arbitration agreements will be watching your case very closely. Thank you, Hassan. Thanks for being with us today. Hassan Zavari. Shauna, back to you.
All right, thanks, Alexis. Well, coming up next, a big milestone here for Tesla, the EV maker, entering the blue chip investment world. We've got the details for you when we come back.
Welcome back to Yahoo Finance Live. Tesla shares are driving higher today, big time, about 8% after Moody's upgrades the EV giant's bonds to investment grade status. Yahoo Finance senior reporter Praz Romanian has been following this story. Praz, that is quite a rise today. Why so?
Well, they're a blue chip company now. You know, this follows what S&P did in October, raising their credit rating to investment grade. Here, I think it's BB3 or something like that for what Moody's calls it. So basically, S&P cited market leadership in EVs, and that's what Moody's is also saying as well for Tesla in terms of like cost leadership, portfolio expansion with the Cybertruck, and industry-wide kind of best margins for production. So yeah, they're doing that upgrade there, and it kind of is a big deal because then it allows Tesla to borrow even more cheaply because they have that higher rating, and then allows other investors to come in, like pension funds, people like that who only invest in very kind of rate sensitive bonds. So that's why they're sort of in play there, and this is sort of happening along like the backdrop of weakening financial conditions where other automakers are having a hard time raising money, or at least with a cheap rate. So Tesla kind of in the driver's seat here, hate to say it, with regards to bonds right now.
Pun intended there, but certainly, obviously, huge year for Tesla. All right, we're speaking about Tesla. One of the competitors out there trying to catch Tesla in the EV space is Ford, and Ford actually unveiled a new their Explorer SUV as an EV, but over in Europe. Any plans for it to come here in the U.S.?
Not right now. It's only Europe only, and it's funny because this Explorer, like famous nameplate as they call it, bringing it to Europe, kind of a handsome package, like a crossover model there. Nice big floating tablet inside. It's kind of a very compelling package, but Ford says a spokesman told me it's only developed for Europe with European customers in mind, and it's also produced in Germany and Europe there, and no plans to export it. It's going to cost around 45,000 euros, around $43,000, so it's a pretty compelling package, but they say it's not meant for the US market, probably because it's the size or maybe range, don't know the range yet, but
I was going to say, it looks a lot smaller than what
I was going to say, it seems like a perfect play for our market. What do they mean by that? Our consumers don't like something of that size?
It's a 2-row SUV. The thought is that most people here want 3-row. They want bigger SUVs. But I have to tell you, in a place like an urban setting, New York City, northern New Jersey, maybe you want a car like that.
Yeah, makes it easier to parallel park in those congested areas.
I love it.
The Explorer, going EV, but only in Europe. Yeah.
Nice little pop for Ford today as well. Praz, good to see you. Thank you, sir. All right, coming up, we're counting down to the closing bell on Wall Street. Stay with us here on Yahoo Finance Live.
We're about a minute away from the closing bell and taking a look at where things stand in the final minute of trading. The Dow just around 300 points to the upside. S&P up about 1.3%. The Nasdaq up about 1.5% today. Taking a look at the sector action, 8 of the 11 sectors trading to the upside. The leadership there from energy, the XLE up just over 3.5%. We're also seeing some pretty solid gains from consumer discretionary communication services. But Dave, a lot of the focus once again today is on the financials. XLF, at least for today, regaining some of that it had lost over the last several trading days, up just over 2.5% today.
And the regional banks, we do have a look at the regional bank ETF. And it's up about 5 today, but big picture, still down 25% over the last month. So yes, certainly gaining back some of those losses. And look at First Republic, up considerably today, about 30%, but again, down 45% over the last 5 days. So it really is relative, considering, yes, gained some back, but overall it's been a very tough week and or month for the regionals. And the question is, what do the markets do upon the Fed news tomorrow? And there's your closing bell.
Exactly. All eyes will be on that Fed decision, 2 p.m. Eastern time tomorrow. Of course, we will have that for you here at Yahoo Finance. But this wraps up today's trading day. All 3 of the major averages ending in the green ahead of that highly anticipated announcement tomorrow. This market check sponsored by Tasty Trade. And as we shake out the final trades of the day, you're looking at the Dow closing up 317 points, S&P up just over 1%, the Nasdaq, the leader today, up just about 1.6%.
JPMorgan Chase CEO Jamie Dimon is reportedly leading talks with the nation's other big banks to stabilize their beleaguered regional counterpart, First Republic Bank. But after the collapse of Silicon Valley and Signature Banks sent shockwaves through the sector, are America's biggest banks still too big to fail? To discuss how the major players have weathered this crisis, we're joined by Argus Research Director of Financial Services Research, Stephen Bigar. Nice to see you, sir. How would you characterize the health of our big banks?
Well, very strong, I think, honestly. This episode has highlighted that the strength of the big banks, that, some of the weaker players where you have some questions about deposit diversification have, led to a flood of deposits into the larger banks. And, I think for good reason, frankly. You've got, much more stringent capital requirements and oversight. And more importantly, millions of depositors relative to some of the smaller banks, in particular Silicon Valley Bank, which was tripped up on just that scenario.
Stephen, is there any risk that we could see another bank fail?
Well, historically, bank failures have been rather low, even to non-existent. FDIC insured banks failures were 0 in 2022 and 2021. We had 4 each in 2019 and 2018. So, still very, very low possibility. Your chances, I think, are a little better at the roulette table than they are to find the next bank that will fail. We've run a lot of screens relative to our banking universe and the S&P 1500 banks. And there were a couple of things that Silicon Valley Bank really had that stood out as problematic. And, the one thing I talked about already was that deposits were accounted for about 90% of funding, which is very high relative to about 2/3 for the average bank. And they also had a depositor base that was deeply concentrated in unprofitable startups. And that's, those were unable to access the capital markets. We've had a dearth of IPO activity. And so basically winding down deposits from prior fundraising just to fund their operations. And of course, lastly, they made a big mistake in terms of the flood of deposits that came in post-pandemic during a very healthy period of capital raising by venture capital into startups. And that money was just not invested well. It was invested in zero-risk treasuries, but they took on a lot of duration risk. And we've just been hard-pressed to find any other banks that fit that profile that would be, subject to the same type of thing.
And these are the reasons you believe SVB was overblown in terms of its scale. Do you think, nonetheless, it will lead to more regulation, should it?
Well, I think that's the inevitable outcome here. There's typically a knee-jerk reaction by policy and legislators to crank down on the industry when a mistake of a single or a few come up here. So yeah, I think, and the one thing that really stress tests did not capture this time, and a lot has been said about, well, if Silicon Valley had been a bank that was subject to the more stringent stress tests, would it have passed? And I think the answer has been yes, universally. But what they seem to miss is that the severe stress is always about a big decline in the economy. You've got interest rates move to 0.75 on the 10-year. They drop a lot. Equity prices move down a lot. Commercial real estate prices. You've got these shocks to the system that are traditional in a big downturn. What they don't account for is what happens when you have a pandemic and a flood of fiscal stimulus and then zero interest rate policy from the Fed for too long, and that creates inflation, and then the higher interest rates that come along. So I think the tests have to be better adapted to what happens to bank balance sheets when there is a big rise in interest rates, and what that does to the value of the investment portfolios. So I think we'll see that. We'll probably see higher deposit insurance. I think there's a lot of it seems to be some growing interest in raising the deposit minimums, which last were raised from 100,000 to 250 after or during the crisis of 2008. So I think there's arguments to be had here. Unfortunately, the outcome could be less profitability for the banking industry at large, though. These higher capital cushions, greater cost of raising capital, and some other legislative and policy items.
Yeah, Stephen, I wanted to ask you a little bit about that, just in terms of the smaller banks, the medium-sized banks, their ability to compete in that sort of environment if of course we do see more regulation. And then is that going to prompt more consolidation within the space?
Well, it likely will. We have some of the not just the smaller, but what I would classify as weaker banks here that have been identified being swallowed up by larger competitors. In the case of Silicon Valley, is not some of the parts will find new homes. Signature Bank and First Republic the same. But bank consolidation has been a theme. It may not seem like an everyday theme, but clearly, moving back, and I've been a bank analyst for about 30 years, and in the early 1990s, we had 10,000 FDIC insured commercial banks. Today, we have 4,700, and we crossed below the 5,000 mark just in 2021. So that's more than a halving in the number of banks in 27 years. So I think this trend will continue. The small get smaller, the large get larger. Interestingly, you would hope that they also get safer the larger they get. And as we've seen, something like Silicon Valley, the 16th largest bank in the U.S., had major issues. But they go deeper than the surface of asset size as we see. And I think the market's gotten a real strong education recently on deposit diversification. And capital cushions and investment portfolios available for sale and held to maturity.
Steve Baker, great to have you of Argus Research. Thanks so much for hopping on with us. We got to get to some breaking news. GameStop out with its most recent earnings report. Look at that, shares popping 17%. Inez has the numbers for us. Inez.
Yeah, and quite a beat on the top and the bottom line. In fact, GameStop reporting an adjusted earnings per share of 16 cents. The street had been expecting a loss per share of 15 cents. Also looking at their net sales, that came in at $2.23 billion. The street was expecting for $2.18 billion. The company also in the fourth quarter reporting proceeds from the sale of digital assets of $4.5 million. So a beat on the top and on the bottom line, a big beat because the company did report earnings per share, a profit per share for its latest quarter. Keep in mind that GameStop had reported losses in all but one of the past 11 quarters. This past one reverses that trend, guys.
Certainly does, and we're seeing some of the excitement out there on the street, up 23%. Keep in mind, though, Yes, the sales was a beat, but it's still off 1% year over year. So coming in just above what the street was expecting.
Yeah, but a catalyst unrelated to the retail trade is rather remarkable at this point. It's almost like if Bed & Bath were to post a solid number at this point.
That is true. It's hard to wrap your head around any of the action that we're seeing in names like this. But again, a huge pop after hours in GameStop. All right, a trending ticker today is Meta, and that's moving on an upgrade from Morgan Stanley. The bank raising its rating on the stock to overweight, lifting its price target to $250 a share. Morgan Stanley giving a number of reasons to back its bullish view. Now, among them, they're talking about Meta's pivot towards efficiency. They also talked about the improving revenue, engagement, and Reels trends that we are starting to see within Meta. But this pivot towards efficiency, Dave, has certainly resonated with Wall Street. We've seen Meta conduct 2 rounds of significant layoffs going back to November of last year when they cut 11,000 jobs. They just announced another round of 10,000 jobs that were cut just last week. So Morgan Stanley, the latest analyst to come out in favor of Meta, or really, I should say, seeing upside here in the name.
Yeah, what was nice about this note is it certainly was excited about the year of efficiencies and the cuts and this, but it also talked to your point about growth, about Reels, about monetization, about engagement, and those are the things that you really have been longing to hear from Meta. Also talking about one of 11 companies they see as most poised to take advantage of the AI boom, which is something you also want to hear with Meta. And one more thing that I really liked, if you're an investor, is that if the consumer weakens, they feel Meta is better positioned than Google or Amazon. So there's a lot to like on this note regarding Meta. It's very widespread.
Yeah, that was interesting to me just in terms of the comparisons there when it comes to ad growth with Meta comparing Meta to Google to Amazon. And the comparison to Google is they're saying that Google hasn't reduced costs as aggressively as Meta has. Amazon, on the other hand, the macro uncertainty could push out AWS, the growth improvements there. Of course, we were talking about AWS's slowing growth with our analyst yesterday, Tom Forte of D.A. Davidson, and he was highlighting the fact that, hey, if they're cutting from those type of areas when it comes to Amazon's layoffs, could spell a little bit of turbulence maybe for the stock over the coming quarters.
One thing I was really surprised to not see in that note was that the potential for a TikTok ban, because many feel that could be a huge catalyst for Meta. The TikTok CEO on Capitol Hill Thursday to defend his company against accusations that it poses a national security threat. Dan Howley has a preview.
TikTok is on the verge of being banned in the US, meaning your days of endlessly swiping on the platform may be numbered. Of course, there's also a couple of conversations to be had about First Amendment rights, data privacy, and what this means for competitors like Meta and Snap. But let's just start first with how we got here. TikTok wasn't always TikTok, at least not exactly. Back in 2014, Alex Zhu and Luyu Yang launched Musical.ly. The app became incredibly popular among US teens and tweens who would use it to lip sync to songs. Sound familiar? ByteDance, meanwhile, was already running TikTok, and seeing how incredibly popular Musical.ly was, decided to vacuum up the company for $1 billion in 2017. It then merged the two in 2018, forming the TikTok we know today. But TikTok's connection to China, coupled with the fact that it's so popular with tweens and teens, sent US lawmakers and regulators into overdrive. It's not as though the app has been without its controversies either. In 2019, it paid a $5.7 million settlement to the FTC over allegations that it violated the federal Children's Online Privacy Protection Act. But the government's main beef with TikTok is over whether it collects US user data, which it can then ship to China and spread pro-Beijing propaganda or spy on Americans. A number of states, federal agencies, and even the military have already banned the use of the app on official devices. Former President Trump attempted to ban the app via executive order, but was shot down in the courts. TikTok then said it would work with Oracle to ensure that US user data is stored on Oracle servers. For its part, the Biden administration has been negotiating with owner ByteDance for months, but the two appear to be at an impasse. Now Biden's throwing down an ultimatum: either sell the app or get out of the US. If that doesn't work, there are a number of bills circulating around Congress aimed at killing TikTok. It's not as though the US is the only country that's trying to ban the app either. In 2019, India outright banned it from its citizens, and both the UK and Canada have banned it on official devices, as has the EU. Where do we go from here? Well, Trump already failed at trying to ban TikTok, so it's hard to tell whether or not Biden will succeed at the same task. Either way, whichever party does ban it is sure to face backlash from younger voters.
All right, Dan Howley, thank you for that preview. I mentioned it was surprising to see this note on Meta not mentioning the potential TikTok ban and what it could mean for Reels, what it could mean for Meta. But ahead of that hearing on Thursday, the TikTok CEO took to TikTok to try to rally some support. Listen to what he had to say.
Some politicians have started talking about banning TikTok. Now, this could take TikTok away from all 150 million of you. I'll be testifying before Congress later this week to share all that we're doing to protect Americans using the app and deliver on our mission to inspire creativity and to bring joy. Let me know in the comments what you want your elected representatives to know about what you love about TikTok.
A few of the things he mentioned in that video is it reiterating that number of 150 million American users on the platform, which when you look at the math is almost impossible, but I'll leave that for another day. Also said there are 5 million businesses on the platform. Very smart play there. He says most of them are small and medium businesses and it would impact their ability to reach the consumer, which is a fair point. But he is going to be facing, unlike any hearing we've seen other than Facebook, I think incoming fire from both sides. Most of these hearings are overly partisan. I see this one as a lot like that Facebook hearing a couple years ago on the harm to kids. Both sides are coming for you. He has got an uphill climb.
He certainly does have an uphill climb, and I think that's why the expectation here is that he will probably do little to convince lawmakers, at least, that they should pivot, that they should change their view, just in terms of the national security threat that TikTok does pose. And we know, you're right, Dave, this momentum it's really been gaining momentum, I should say, this view that is over the last several months. I thought it was very smart of him to point out the fact that, yes, 5 million of those accounts are businesses. Also disappointing the fact how many more, even larger businesses, it's not only small and medium-sized businesses, larger businesses are allocating their marketing revenue towards influencers that use TikTok, that use some of the other social media sites to really resonate with fans, to get their product out there. It could have massive implications beyond even the smaller and medium-sized businesses in the long run.
Not entirely clear, though, when there are plenty of alternatives, most notably the aforementioned Reels and Meta. They do have almost a 6 to, maybe it's a bit different in terms of the algorithm and their ability to interact with the consumer, but it is still a very similar reach for this business. This is going to be must-see TV tomorrow, I'll tell you. And important for our national security and our children.
Yeah, very, very important. Of course, we will bring you the latest on that testimony. But coming up next, a deeper dive into GameStop's quarterly results. You're looking at a pop of 32%. We'll be right back. Some breaking news here. Nike shares up about 3.5% on the heels of its earnings results. Josh Schaefer has the numbers for us. Josh, what do you got?
Yeah, Shauna, so we've got a beat on the top and bottom line here for Nike. So if you take a look at the revenue coming in at $12.4 billion, that was over an estimate of $11.5 billion. And then adjusted EPS coming in at 79 cents. That beat Wall Street estimates of about 55 cents. Now, big story here for Nike has been inventories. Inventories coming in up 16% year over year. That beat the Wall Street estimate of 18.5% and is now the second straight quarter that Nike has seen declining overall inventories. Nike CFO noting in the release, we have made, quote, tremendous progress in terms of inventories. Now, gross margin coming in at 43%. That was right about in line with what the street was expecting. That's the fourth straight quarter, though, of gross margin declines for Nike. Couple other key numbers. North American revenue coming in up 27%. That beat Wall Street estimates. Greater China down 8% year over year. A little bit wider of a decrease there than what Street had been expecting, guys.
Yeah, certainly we're seeing the reaction here after hours of the stock up just over 3%. We want to talk a little bit more about this, dig into these results. For that, we want to bring in Adrian Yee, Barclays consumer discretionary analyst. Adrian, it's good to see you here. So it looks like the street's satisfied with this report. What's your initial take?
This is a good report. This is an extremely good report. I think they hit on all the areas where people were somewhat concerned about. Certainly the inventory was probably singularly, we've been talking about inventory probably for the past 3 quarters, if not longer. But the excess inventory, at least for the past 3 quarters, really getting that in check and having the sales be up. So I think you heard me probably the last time I was on, I said the best way to get rid of inventory is to beat your sales number. And that extra, $900 million on the top line will certainly help.
And their CEO speaking of a digital advantage that fuels brand momentum. How are we seeing that in the report, Adrian?
Yeah, so their DTC business, right? So they have 2 components of the business. They have wholesale, which was also up strongly. It was up 12%. So that piece of the business was up. But remember last quarter, wholesale was up more than DTC. And everybody was like, oh, well, the DTC strategy must not be working. Well, this data point proves that not only can they drive the wholesale piece of the business, but the brand heat itself and all the new high heat products that they are putting forth into the marketplace at retail in their own channels and their partner channels is actually working. We had Foot Locker yesterday report, right? And Foot Locker even talked about the notion that they are not seeing the departure, right, of Nike as quickly because there's so much demand in the retail market for their product.
Adrian, real quick, there were some questions going into this report just about the fact that Nike did lose its chief digital officer earlier next year, that maybe that would signal some sort of strategy shift here going forward. Do you see that at all as maybe a risk here? Maybe this number that we're seeing today won't be as strong in the coming quarters?
I don't, actually. And the reason I say that is because these strategies were laid out a couple years ago in their long-range plan, in their 4 or 5 year long-range plan. So these changes and these directional kind of shifts, they do not come lightly. The company had talked about shifting sort of from pre-pandemic to post-pandemic over that kind of 3-year horizon to get from, 40%, to shift another 20% sort of into the digital channel. And what we're seeing is that their DTC, total DTC business today sits at just over 40%, about 42% as of the last quarter. But only roughly half of that is digital. And they want 40% of the business to be digital. So there's no change in strategy. I think the leadership changes, that happens over time. But these strategies are well laid out, over a multi-year horizon.
Adrian, Greater China revenue down 8% again on a year-over-year basis. Just curious what you make of that potential headwind. Do you see that going away moving forward? How are you evaluating that right now?
If there was one part of the press release and sort of one data point that did not live up to expectations, right? Like clearly the North America market beat by 500 million. So all the other areas, APLA, EMEA, they all kind of constituted the remainder of the beat. But you're absolutely correct. We actually could call the Greater China a slight miss relative to consensus expectations, where I think they were sitting at like 2.1 billion, 2.05 billion. What I would say is, constant currency, it was up. It is a very volatile market there. We know that they are aggressively marketing in the China market. They're also kind of being very price sensitive, but then so are all the other Western competitors as we try to come out of this. So I would say that we're on the second quarter of constant currency growth. Last quarter was 5%. This quarter is 1%. We wanted to see more from them. But the fact of the matter is everything you hear from Global Luxury and all these other players that are opening in China, they're all talking about sort of a bumpy road, but the direction of travel is up and reopening. And remember, a lot of the greater China sales, not only do they happen within China, but once you see these Chinese consumers start to travel, you're going to see a significant portion, double-digit portion of Chinese consumer sales that happen outside of the mainland China.
One thing you won't see in this report, but I want to get your thoughts on the opening created by the breakup between Kanye West and Adidas. How significant is that opportunity for Nike?
I think it's a huge opportunity. So if I may make a comment, the knock on Adidas has been that they relied too heavily on the Yeezy innovation, and that they themselves have admitted this, that they were not, keen on kind of a multi-year, and we're talking like 2, 3, 4 years in the pipeline of innovation. That's the kind of product development R&D that Nike does. They have a 4 or 5 year horizon of, kind of filling the pipeline with short-term product, medium-term product, and long-term product. And I think what you're seeing here is that long-term investment has not been made by their single biggest competitor, and Nike has been making it. So there's a lot of kind of open market share that is sort of up for grabs, particularly in the China market when they reopen. And I think this print from Nike is testament to the fact that they have invested throughout the pandemic, and it's going to pay off.
Adrian, going into this report, you had a neutral rating, enough to make you more bullish on this name?
We going into the print, we kind of previewed a lot of what's happening here on the upside. And I have to say, there's some regrets about not kind of stepping up to the plate in front of this print. We knew that there was some good momentum, and our data points had definitely suggested that. We had no idea there was almost $1 billion of upside on the top line. So yes, this is a incrementally positive, data point for sure.
And with the print, we obviously saw Nike hold up through the holiday period. Curious, when we think about the broader consumer demand in the retail space, is that still a big concern for Nike, or do you think that Nike's maybe a net winner there when some other retail players might not be?
That's a great question. What we are seeing starting at the beginning of March is complete kind of anemic behavior from the consumer. I mean, in apparel and sort of other product categories, you are seeing, high promotions with clean inventory and negative sales. So there's a real inability to convert. And this consumer really is very tight with their money, and they do not want to be coming out and buying more product, right? They have shifted to services, but for 2 categories. The first category being athletic footwear, the second category being beauty. Those 2 categories are highly, highly resilient. I think partly because they are all about kind of health and wellness and investing in yourself. And so those 2 categories continue to maintain momentum, notwithstanding an overall kind of pall in the consumer space.
Adrian Yee, that was outstanding. Thank you so much. Very much appreciate that
Thank you.
analysis. Really good. All right, GameStop surging after reporting a beat on the top and the bottom line. Yes, GameStop beat on the top and bottom line on fourth quarter earnings. And look at shares up more than 33%, albeit from a relatively low level. Nonetheless, let's dive deeper into this report with Ihor Dusanowski. Good to see you, S3 Partners Managing Director. Wow, what's your reaction to GameStop beat top and bottom?
Hey, Dave. Well, basically, release the hounds, let the short squeeze begin. The shorts were profitable till around 10 a.m. today. By the end of the day, they were down $40 million in mark-to-market P&L. Aftermarket trading down, give or take, $300 million. So they're taking a big punch to the gut. We should see some big short covering tomorrow.
Ihor, how much short activity have you seen in GameStop lately?
It's been around 1 million shares of short covering over the past month, around 500,600,000 shares over the past week. So there's already a skew to shorts kind of losing some of their conviction. And the guys that got out did the right thing.
For quite some time, GameStop's share price has been totally disconnected to the actual business. Is that still the case?
Yeah, this is really momentum stock. You've got to sit there and look at what's going on with the meme stocks, the Reddits, the Twitter. This is not just, hey, what's the value? What's the earnings? This is what does the street think that the price needs to be.
When we talk about some of the mechanics, some of the, I guess, breaking down exactly the trading action that we have seen, has that really diverged from what we were seeing 2 years ago when we first started talking about GameStop as a meme trade?
Yeah, well, the short interest isn't nearly as much as we saw a couple of years ago. It's really calmed down a bunch, but the volatility is still there, and this is where the long players and the short players are making and losing money on a daily basis in size. And we're seeing big moves in the short side where we're seeing, for a while there, we saw shorts accumulating positions. This year, we're seeing shorts decreasing their positions. It's still a meme stock. You're still going to have a lot of action on both sides of the trade.
Can you talk about the shorts that you've seen as related to First Republic? We've been trying to diagnose what happened with SVB. Of course, First Republic had a massive struggle. They have since rebounded. Certainly a great day today on the words from Janet Yellen and Jamie Dimon and others. But how much short are you seeing there?
Yeah, we're seeing it's a small short amount just because the stock price is so low, $69 million. It's almost 6 million shares shorted. The big thing is we saw short selling into the contagion, let's call it, with that 600,000 shares shorted since the 8th, almost 1 million shares short over the past month. So there was some short interest in this stock as the price started trending downwards.
Igor, when we talk about the regulators' activity here, going in obviously already with SVB and with Signature Bank, some talk about maybe the fact that they could potentially intervene again. Treasury Secretary Janet Yellen leaving that door open in comments earlier today. What's the fallout for some of these traders who would be short or potentially are short on these stocks?
I mean, look, you're up $500 million in 2 weeks. So this is a big bunch of P&L that you got in your pocket, but you can't buy a cup of coffee with it because you haven't realized the trade. So what's going to happen is you're going to see some of these traders who are up big start closing out their positions and realizing their profits before they can't. Stocks get traded, you got bankruptcy, you got takeovers, you got whatever issues that come in this name. It's going to hinder the possibility of closing out a short position. So there's going to be a lot of trading in this name. A lot of it's going to be short covering because these guys want to cash in their chips.
All right, great stuff. We'll have to leave it there. Ihor, thank you so much. Appreciate that. All right, before we head to break, let's do a quick check of the markets, sponsored by Tasty Trade. And yes, they continue to rally in spite of the uncertainty, perhaps because of the words of Janet Yellen today. You see the Dow with a 1% gain, roughly. The S&P up 1.3%. And the outperformer today remains the Nasdaq, continuing to show momentum after a terrific week last week. Gains 185 points, or 1.58%. Coming up, NVIDIA flexes its AI muscle amid the ChatGPT hype, but see how the new technology stacks up against the competition. And the Duckhorn portfolio chairman and CEO and president Alex Ryan tells us why there's still plenty of demand for luxury wine despite high inflation, and we'll ask him if there's any impact from the downfall of SVB.
Well, NVIDIA is going all in on AI technology at its GTC 2023 Developer Conference. The company is rolling out new services and hardware advancements in generative artificial intelligence, the metaverse, cloud computing, and more. By the way, I'm Julie Hyman. I'm joined by Dan Howley, and we are both joined by Manavir Das. He is Vice President of Enterprise Computing at NVIDIA. Manavir, thank you so much for joining us. I know you're very busy with the GTC conference. So what's interesting to me is a lot of the conversation around AI thus far has been around consumer-facing AI, right? Because people can now see and use ChatGPT. There's a lot of enthusiasm around this. I actually spoke to an executive at Adobe earlier today about their approach to enterprise AI, or AI for enterprise. And I'm curious, when you're looking at that aspect of it, what is sort of the biggest revolution that you see in AI capabilities for companies and how it's going to change the way that they work?
You know, Julie, that is really our focus. I'm so glad you started with that because, look, ChatGPT has really opened the eyes of the world. It's an amazing invention. And it's really one very large AI, one very large model that is used by millions of people across the world at the same time, right? Whereas if you think about companies, a company like Adobe or a bank, what they're really looking for is their own AI, their own model that is based on the knowledge that they have in their company that acquires the skills that they need to run their business and that communicates effectively with their customers for things that their customers are interested in, right? So every company actually needs its own ChatGPT, right? Its own AI model, if you will. And so the approach that we've taken at NVIDIA is how do we help all of these enterprise companies get that, right? Each in their own unique way. That's why we're working, for example, with Adobe. And the platforms that we announced today are all about democratizing this across enterprise companies so every company can infuse generative AI into their business.
Manavir, I want to ask what you think is the biggest opportunity for companies when it comes to developing their own AI models using this kind of technology.
You know, it's amazing because you take any function that humans are doing in a company, you know, there is so much help that a human can get in doing their day-to-day job, right? Whether it's the mundane activities they do or looking up information, finding the right answer to something right at their fingertips. Maybe you're talking to a customer, helping them troubleshoot something. And you know, in the back of your mind, some other customer experienced that a year ago. But with these AI models now, you can just get that information right away and help your customer, right? So wherever there's human productivity, there's an opportunity for generative AI to increase that human productivity and create a better experience.
Manavir, if you could get a little more specific about what you guys have just announced with regard to all of this, how it's different for you, because you guys have been operating in AI already, of course, when it comes to chips. But how is this different or a step forward for NVIDIA?
Yeah, that's a great question, Julie. So there's two ways in which this is different. So we've always been the provider of the underlying hardware, the GPU that really makes AI go, right? Because on GPUs, you can run AI, you know, hundreds, thousands of times faster than you could on CPU. So we've always done that. So we have two new things here at GTC. The first is something called DGX Cloud, which is a service that we provide in the cloud. And the idea is, you know, when you do AI as a company, you do some data science with data scientists who have to understand how to do AI. But the much more complex part of it is the engineering, because you have to stand up these supercomputers, if you will, that have the horsepower to actually run AI. And that's a very difficult thing to do. So what we've done with DGX Cloud is it's a new capability that's available, hosted on the public clouds, where companies can come in and rent one of these supercomputers that we've already built on their behalf. And we've done all the engineering work. They can just consume as big or as small of it as they want for as long a period of time. And we've taken care of all the engineering. So all they have to worry about is the data science, which is where all the innovation of AI is, right? So that's the first new thing. The second new thing is a platform called NVIDIA AI Foundations. And so really the way to think about that platform is for a company that wants to embrace generative AI for its own business, which means they have to build their own AI models fed with their data customized with the skills they care about, with guardrails so that the AI model only does the things that are appropriate for their business. They need a foundry, if you will, to create these models. And that is what NVIDIA AI Foundations is. It's a foundry where companies like Adobe can come in and create their own models, whether it's text to text or text to video, text to images, or even the language of biology, which is used, for example, in drug discovery. So DGX Cloud and NVIDIA AI Foundations, these are the new things that NVIDIA is bringing to market.
Manuvir, do you see generative AI as the next big growth opportunity for NVIDIA, or do you think it's something that's been very hyped and part of a larger whole?
We think it absolutely is a big growth opportunity, Dan. And the reason is, NVIDIA for years now has worked with companies to adopt a variety of use cases for AI that are specific to their business. But, every company has to get bought in. I think what's happened with ChatGPT and generative AI is we have come to the moment there's a broad horizontal use case that every company, no matter what industry it's in, can see the value of that. And I think this is what is really going to make the adoption of AI take off. And obviously, NVIDIA is very excited to be part of that. Firstly, because the best way to do generative AI is, of course, on NVIDIA GPUs. So we're happy to work with everybody who does generative AI, companies like OpenAI. And secondly, with the new platforms that I just told you about, there's an opportunity for customers to come work with us directly on those platforms, even as we help the entire ecosystem, companies like OpenAI, who we have the greatest respect for, be as successful as they can be.
It's obviously a very interesting time for us, for you, for everyone interested in this area. Manuvir Das, Vice President of Enterprise Computing at NVIDIA. Of course, Dan Halley as well. And as that GTC conference goes on, we are going to be speaking with the founder and CEO of NVIDIA. Dan and I will be speaking with Jensen Huang tomorrow. That's at 4:10 p.m. We'll be talking to him about AI, but about much more as well. And we are very excited about that conversation. You don't want to miss it. Coming up next, Shauna and Dave will be back with much more Yahoo Finance.
The Silicon Valley collapse has rattled sectors like tech and banking, but those aren't the only industries feeling ripple effects of what transpired. 2% of the bank's loans as the end of 2022 were going to premium wine producers and vineyards. Joining us now is Alex Ryan, the chairman, CEO, and president of the Duckhorn portfolio. Nice to see you, sir. While you speak, I'm going to make sure I open this bottle and we can all share a glass together. How have you been impacted by the SVB collapse, and how have you seen the industry impacted?
We have no meaningful exposure there. As everyone asks those hard questions along the way. They bank a lot of wineries, but it's not as big as you might think, right? It's a big industry with a lot of good bankers and a lot of well-capitalized wineries. So I'm not looking at that as a major downturn in our industry, just a little hiccup along the way.
Yeah, we spoke to Kevin O'Leary, Mr. Wonderful of Shark Tank, obviously, who has heavy exposure to the wine industry, very involved in there. We got his take on SVB's impact. I want to play a quick clip and then get your reaction.
The wine industry is unique. It's been very, very, very successful in California. Some of the varietals we make, we're all proud of. But clearly our cost of capital, and I say this as a participant, is probably going to go up 30%. No question about it. It's going to make the larger operators probably more protected around a moat, and the smaller ones are going to be acquired by the larger ones. It's going to force consolidation in the wine industry.
Do you think we could see some consolidation as a result?
I think you're going to see a little bit, not directly as a result of that. I think it's a broader opportunity for the wine industry. It's getting a little more competitive out there, and they're going to be the have and the have-nots. You need to be well capitalized, and some of the banking points are valid, right? We need to run a good, tight banking system. More importantly, long-term, I think you're going to see luxury brands that have authenticity and really reason to be in the market, and those that are kind of treading water a little bit. So that's where the divide I see is going to see really in the premium wine industry for the next couple of years.
They conduct SVB wine industry analysis in which they said the only growth they're seeing is over the age of 60. Are you seeing that at Duckhorn? And how do you get a young consumer to start drinking wine?
That's a wild topic right now for the news. We're not seeing that in our data. We're seeing younger consumers in our entry-level wine, the decoy we're sharing today right now, come in. They still want to be a part of a wine lifestyle, right? The wine's been around since the Romans. It's not going anywhere. The category's not going anywhere. Young people are going to have to get in where they can afford to get in. They want part of that lifestyle. They want to be validated that their purchase is exciting, meets with their price point and their flavor expectations. I've seen the same reports. There's a broad group of categories of age groups, and I do believe the category is strong enough to continue to entice new, younger consumers in as those older ones who are clearly buying a disproportionately large amount of the share kind of move on. But I don't think we're going to see a massive disruption. It's what you deliver to those people. Those young people want to be validated that they're choosing good wine, and you've given them everything they expect. If you do that, I think you got a good shot in the long term.
It's terrific, by the way.
Well,
It's
thank you very much.
good, very good. We're all taking
it.
sips while you were answering that question. Alex, what are you seeing in terms of the strength of the consumer? Any evidence that consumers are trading down with your brand, given the fact that inflation still remains so sticky?
It's the topic du jour, right? We're watching it closely in our tasting rooms, with our trade partners, with our distributors. What we're seeing, and I can't really speak for everyone, what we're seeing is we're not seeing any trade down right now. Actually, we're seeing, this is an interesting bottling right here, the one you chose. We're trading them up the price point. This is about $5 more than our more traditional decoys. So we're starting to see some opportunities to trade up. I don't think that's true for everyone, but right now we're not seeing people leave our portfolio, but more importantly, we're not seeing people en masse leave luxury. Luxury, in our business defined as $15 and up. We kind of cluster in that $20 to $200 range. We're not seeing people leave the category, and that's really, really exciting.
The other industry trend that SVP is seeing is direct to consumer. What are you guys seeing in that capacity?
It's our best form of marketing. It's our stickiest sale. We're getting closest to our customer. We've been big in that since we first initiated it in 1980, back when my predecessor, the founder of the company, Dan Duckhorn, got it going. And it is now exploded. It's the way you want to talk to your customers. It's it's going to continue to grow, and we're going to put some more marketing dollars behind it to make sure that we're touching the consumers wherever they want to find our wines.
You certainly have seen massive growth there. Before we let you go, we got to get your take. You are the expert here. Your favorite. What would you say? I know it's hard. It's like picking a favorite child probably for you. Yeah. But you got to give us some tips.
In your favorite child, the answer is typically, well, it depends. And right now, Actually, it's funny, oddly enough, you opened our Decoy limited wine, the upscale Decoy product is exceeding our expectations of the market. We released it a couple years ago. It's doing better than we thought. That's getting us exciting. We're starting to come up with some new bottlings within the Decoy limited. Today, with you guys, it's my favorite. Tomorrow, it might be a Duck Run Sauvignon Blanc.
Safe answer.
Before you go, there's been a lot of focus on the climate, in particular in California, the massive snowfalls that you're seeing. What has been the impact on your business, on your
We're a Mediterranean climate. We need water. We all know that. Great. The rains have been wonderful. They're replenishing the soil, the reservoirs. People are getting the water they need. It's good for the economy of California. It's great for wine business. The vines are asleep, so you're not going to affect anything. We've had a couple of down trees and a couple of hiccups. The reality is California's dependent on winter rains. We need those. We've had a couple tough years. So it's all good. It's good to a 2023 harvest. A lot of crop, good quality.
No
and
downside.
It's good immaterial.
Wow.
Immaterial. It's exciting to get water back, and we're going to grow. We're going to make better wine because of it.
Remarkable.
Cheers to you. Thanks, guys.
Alex Ryan, great to have you here. We very much appreciate that.
My
All right,
pleasure.
coming up. Let's break down some of the biggest takeaways from today's top stories. Next.
Let's take a look at what is trending after hours. Two stocks here for you, GameStop and Nike, both have to do with earnings. Let's get right to it. Look at GameStop. They're up over 30% in after hours trading. The company reporting its first profit that we have seen in just about 2 years. They also beat on revenue. Certainly the street encouraged by this. And I want to remind you, GameStop, very, very few analysts cover it. Given the recent trading activity, given the fact that it is associated with the meme stock, and really simply the fact that it's been trading totally unhinged from the fundamentals of this play. But intraday close up just around 4.5% ahead of these results year to date. Taking a look at that performance, off just about 4% over the last year. And take a look at that volatility, really speaks to the fact as to why so many few analysts cover this. But over the past year, off just about 25%. All right, moving on to Nike. The shares initially were gaining after hours. Now we're in the red, off just by about 0.7%. Digging into these results, they actually beat on both the top and bottom line Progress on inventory was one of the highlights. Nike there saying that it was tremendous progress on inventory. It was up 16% on a year-over-year basis, a huge improvement from that 43% jump that Nike reported the previous quarter. It wasn't all good news here for Nike. They did miss on their China revenue segment there. That came in slightly below what the street was looking for. Also, its full year gross margin was at the low end. Forecast there was at the low end of its prior forecast. Over the last year, you're looking at Nike shares off just about 3.5% year to date. That stock up just over 7%, Dave.
You know, a pretty good report considering the numbers from China, and a lot of upside if they can get that turned around moving forward, right? All right, thank you, Shauna. Let's get you to closing time here at Yahoo Finance. Caught up on some of the biggest headlines of the business day. Treasury Secretary Janet Yellen injecting some calm into the markets. In comments to the American Bankers Association, Yellen said the government is ready to step in and help protect smaller banks if necessary. She also said the situation with banks is stabilizing and that the U.S. banking system remains sound. Those comments giving stocks a boost, with the Dow closing more than 300 points higher.
All right, well, Nike's third quarter earnings topping analyst estimates on both the top and bottom line. The retailer reporting adjusted earnings of 79 cents a share, well above the expectation of 54 cents. However, despite some improvement on the inventory front, the company's margins continue to be a concern here for investors. You're looking at the shares off in extended trading.
And turning to tomorrow, all eyes on the Fed. 2 p.m. Eastern time, we'll find out if the Fed is raising rates. The expectation is we'll see a 25-point basis hike, but given the recent banking turmoil, some are hoping the Fed hits the pause button. We'll bring you that announcement here live on Yahoo Finance.
We certainly will. All right, well, that does it for us today on Yahoo Finance Live. Thanks so much for tuning in. We'll see you right back here, 2 p.m. Eastern time tomorrow for that Fed decision. Have a great night and cheers.